China boasts one of the world's largest aviation markets, hundreds of millions of passengers, gleaming new airports, and a fleet rivaling the US. Yet year after year, Chinese airlines struggle to turn a profit. In fact, even as travel rebounded in 2023 to 2025, China's big carriers continued to post losses while global peers returned to profitability. It seems counterintuitive. How can airlines carry so many passengers and still bleed red ink? Is it mismanagement, bad luck, or something more systemic? At first glance, it's baffling. China's airlines should be minting money given the country's growth in air travel. Instead, the big state-owned carriers, Air China, China Southern, and China Eastern, lost an average of $286 million each in 2024, extending a trend of losses since the COVID-19 shock. Meanwhile, a private budget airline like Spring Airlines somehow remains profitable. The thesis we'll explore is that Chinese airlines are caught in a pincer of high costs and low unit revenues. In industry terms, their CASK, cost per available seat kilometer, often exceeds RASK, revenue per ASK. In simple terms, they spend more to fly each seat than they earn from it. To understand an airline's profitability, two acronyms are key: RASK, revenue per available seat kilometer, and CASK, cost per available seat kilometer. Think of RASK as how much money an airline makes for each seat it flies for 1 kilometer, and CASK as how much it spends to fly that seat. If RASK is higher, the airline makes money. If CASK is higher, it loses money on each seat kilometer flown. This is the critical battle of unit economics in aviation, and in China, that battle is being lost. Chinese carriers have seen their RASK battered in recent years. Ticket prices, especially on international routes, are still well below pre-pandemic levels. As of late 2025, fares remained 22 to 34% lower than in 2019, as airlines slashed prices to win back travelers. Domestically, a glut of capacity and price sensitivity pushed the average fare during the 2025 summer peak 10.6% below 2019 levels. Simply put, the amount earned per seat, RASK, has been stuck in a slump. Meanwhile, costs per seat, CASK, have risen with fuel prices, a weaker Chinese yuan, and operational inefficiencies. The result, a persistent negative RASK-CASK gap. For China's big three state airlines, unit costs exceeded unit revenues enough that all three remained in the red through 2023 and into 2025. Let's illustrate this with a simplified model. Imagine an Air China flight generates an average of 0.50 yuan in revenue per seat kilometer, RASK, but incurs 0.55 yuan in costs per seat km, CASK. Over millions of seat km, that 0.05 yuan deficit adds up to huge losses. His isn't far from reality. In 2024, China's big three lost roughly $250 to $300 million in average, despite high load factors, indicating that system-wide RASK was still below CASK. In other words, every kilometer flown was, on average, a money loser. Rhetorical question: how do these airlines stay afloat if they're effectively selling tickets for less than it costs to fly passengers? The answer: government support, ancillary businesses, and hope for a more favorable future. We'll get to that. But first, we need to unpack why costs are so high and why revenues are so low. Understanding those pieces will clarify how the RASK-CASK gap became so stubbornly negative in China. Flying is expensive everywhere, but in China there are unique cost burdens stacking the deck against profitability. Let's break down the major cost components, many of them largely outside the airline's control. 1. Jet fuel. The 800-pound gorilla. Fuel is typically the single largest operating cost for any airline, and in China this is pronounced. Fuel expenses account for roughly 30 to 40% of Chinese carriers' operating costs, higher than many global peers. There are a few reasons. Chinese airlines often have less aggressive fuel hedging. Many didn't hedge much at all, so when oil prices spike, they feel it immediately. They also pay in US dollars for imported jet fuel, which hurts when the yuan weakens. In recent years, oil prices climbed off their 2020 lows, and Chinese jet fuel procurement costs jumped. As a result, fuel costs surged back for the airlines. In one case, China Eastern saw jet fuel expense soar 45% year-on-year when oil rebounded. To put sensitivity in perspective, Air China estimates that a 5% increase in fuel prices will boost its annual fuel costs by about 1.2 billion yen, roughly $170 million. That's a huge hit to the bottom line. And fuel volatility has been wild. 2022's oil price spikes, above $100 per barrel, dealt massive blows to Chinese carriers, contributing to record losses. Even in 2023 to 2024, fuel prices remained elevated compared to 2019, keeping CASK high. 2. Forex and debt, currency pain. Costs like fuel and aircraft leases are dollar-denominated, but revenue is mostly in Chinese yuan, RMB. This currency mismatch has been brutal. The yuan's value slid against the dollar, especially in 2022 to 2023, meaning it took more RMB to pay the same dollar bills. For Air China, a mere 1% depreciation of the RMB versus the USD shaves about 133 million yuan off net profit, around $18 million, due to pricier dollar costs and revaluation of dollar debt. And the yuan moved a lot more than 1%. At times it weakened by 5 to 10% year over year, translating to hundreds of millions in forex losses. The airlines carry hefty dollar debt from buying new planes. Those loan repayments swell in local currency terms when the RMB weakens. This is essentially a hidden cost. Currency swings have repeatedly torpedoed Chinese airlines' earnings, even in years when operations were okay. 3. Fleet and finance costs. China's big airlines expanded aggressively in the 2000s, ordering hundreds of new jets to serve ever-growing demand. That means high depreciation and lease costs now. In Air China's cost breakdown, for example, depreciation and amortization made up approximately 17% of operating expenses in H1 2025, a significant chunk. They have to pay for those shiny Boeing and Airbus planes, whether or not they're filled with high-fare passengers. Finance costs, interest on loans, add further weight. Air China had nearly 2.9 billion yuan in finance costs in just 6 months. Essentially, Chinese carriers are highly leveraged to growth. When growth doesn't translate into profit, they're stuck with big fixed costs. By contrast, an older fleet that's paid off, or smaller growth ambitions, would ease this pressure. But that's not China's path. 4. Fees and charges. Operating in China comes with its own set of government fees. Airlines must pay a Civil Aviation Development Fund levy on each ticket, effectively a tax used to fund infrastructure. They also face airport charges for takeoff, landing, and ground services. For Air China, airport and navigation fees constituted about 12% of its expenses, the second largest cost after fuel. China's major airports, like Beijing Capital and Shanghai Pudong/Hongqiao, have invested heavily in modern facilities, and the airlines shoulder part of that cost through fees. There's also an inefficiency element. Unlike some deregulated markets, Chinese airlines historically couldn't freely adjust capacity or exit unprofitable routes if mandated to serve them. Provincial governments often expect airlines, especially state ones, to maintain flights for development, which can mean flying half-empty planes on money-losing routes, essentially an indirect cost of policy obligations. 5. Airspace constraints and delays. Perhaps the most uniquely Chinese cost factor is the military's tight grip on airspace. Only about 20 to 30% of China's airspace is open to civilian flights, compared to approximately 85% in the United States. The People's Liberation Army reserves huge swaths of sky for its use, forcing civilian flights into narrow corridors and suboptimal routes. The result? Chronic congestion and delays. For years, Chinese airports languished at the bottom of global on-time rankings. At one point, over 80% of flights from Beijing Capital Airport were delayed, and Shanghai wasn't far behind. Although punctuality improved to about 80% by 2018 after concerted efforts, new airports, schedule discipline, etc., the underlying airspace crunch remains. Why do delays and congestion matter for costs? Because they force airlines to pad their schedules. Longer block times mean planes and crews spend more time per flight, and burn extra fuel waiting to land or taking longer routes. It's essentially inefficiency. Chinese airlines routinely add significant buffer to flight times. A flight that could be 1 hour might be scheduled for 1.5, just to improve on-time stats. That means more crew hours paid, more fuel consumed, fewer flights per plane per day. All of that inflates CASK. It's like a hidden tax on operations. One study found that HSR competition even improved airline delays, because when a high-speed rail enters, airlines reduce flights and congestion eases, ironically. But absent that, delays have been a persistent cost driver. All these factors, fuel, forex, fleet, fees, and delays, add up to a heavy cost base for Chinese carriers. In boom times, they could perhaps still eke out profit. But when revenues are under pressure, as we'll see next, this cost stack becomes crushing. As an aviation analyst put it, the underlying issues remain unresolved for China's airlines. They face structural cost challenges that drag on earnings. Now, let's turn to the revenue side of the equation, where another set of challenges awaits. If costs are high for Chinese airlines, their revenues have been stubbornly low. Part of this is self-inflicted, a capacity glut leading to fare wars, and part is external, competition from one of the world's most advanced high-speed rail networks. Either way, airlines in China have struggled to lift their RASK. Let's explore why their pricing power and ancillary revenues are limited. 1. Oversupply and cheap fares. China's domestic aviation market until recently was growing approximately 10% plus per year in capacity. Even when demand wavered, airlines, especially the big three, kept adding routes and flights, often encouraged by local governments building new airports. The result? Too many seats chasing too few passengers on many routes, driving fares down. In mid-2025, during the busy summer travel season, the average one-way domestic ticket was only 788 yuan, $110, down 3.7% from the previous year and about 10% below 2019's level. Airlines were essentially undercutting each other. Ticket price regulations have also played a role. Historically, the CAAC set a price cap and floor for economy class on domestic routes. While China has gradually liberalized fares on many routes since 2018, especially where there's high-speed rail competition, the intent was often to lower prices to benefit consumers. So, unlike in the US, where deregulation led to yield management and sometimes higher last-minute fares, in China the policy emphasis was on keeping air travel affordable. Great for travelers, tough for airline RASK. The pandemic recovery exacerbated this oversupply issue. When travel curbs lifted in early 2023, all airlines rushed back into the skies, but demand patterns had shifted. International travel was slower to rebound. Some restrictions lingered and visa hassles persisted, so carriers dumped capacity into the domestic market, sparking price wars. As one report noted, excess capacity and low fares are key factors weighing on performance. The big state carriers essentially admitted that they'd oversupplied the market. Low fares fill planes. China's domestic load factors have been reasonably high, but they don't cover costs in many cases. 2. High-speed rail, HSR, competition. Perhaps the most distinctive revenue challenge in China is the extensive HSR network offering travelers a speedy alternative to flying. China's bullet trains are fast, frequent, and city center to city center, a very attractive combo for trips up to 4 to 5 hours. Routes that airlines used to dominate have seen passengers flock to trains. The flagship example is the Beijing-Shanghai corridor. In 2011, the new high-speed line opened. By 2019, the Beijing-Shanghai high-speed railway was carrying around 210 million passengers annually, far eclipsing the air route. By 2024, airlines offered only about 7.7 million seats for Beijing-Shanghai flights, serving a fraction of total travelers. The balance decisively tilted to rail. What that means for airlines is not just lost volume, but lost pricing power. They can't charge premium fares on a route when a traveler can take a 4-hour train that's often cheaper and more convenient. Economy airfares dropped significantly after HSR arrived. One study found that on Beijing-Shanghai, airfares and demand both fell sharply, with economy fares dropping and air passenger volumes down approximately 34% post-HSR. Essentially, HSR capped what airlines can earn on many prime routes, and it's not just Beijing-Shanghai. High-speed rail now blankets China's eastern half. Routes like Shanghai-Guangzhou, about 1,200 kilometers, are connected by fast trains, around 7 hours, that eat into the market for flights. In some cases, airlines have retreated. When the Zhengzhou-Xi'an high-speed rail line opened, 505 kilometers distance. Airlines cancelled all flights on that route within 48 days due to vanishing demand. On the longer Wuhan-Guangzhou route, approximately 1,070 kilometers, airlines initially operated 15 daily flights. A year after HSR began, they were down to 9 flights. It's a 1-2 punch, fewer passengers, and the need to lower fares to compete. High-speed rail is often cheaper, and with dozens of departures a day, more flexible. Chinese business travelers, who might pay high fares elsewhere, often prefer the train for many city pairs, depriving airlines of lucrative business-class sales. Simply put, HSR has stolen the airline's lunch on short-haul routes. This keeps airlines' yields, RASK, low, particularly on dense corridors that elsewhere in the world might be cash cows. 3. Limited loyalty program. Monetization. In the West, airlines have a secret weapon for revenue. Frequent flyer programs that they leverage into huge cash generators, mostly by selling miles to credit card companies. In fact, US airlines now rely on loyalty programs for a large chunk of income. In 2024, loyalty and credit card partnerships contributed 10 to 20% of total revenue for majors, e.g. approximately 11% at American, 12% at Delta, and without that, those airlines would be unprofitable. Chinese airlines have frequent flyer programs, Air China's Phoenix Miles, China Southern's Sky Pearl, etc., but they haven't turned them into such cash cows. Co-branded credit cards in China exist, but aren't nearly as ingrained as in the US. Chinese consumers historically use less credit, and the banks have tighter regulations on interchange fees, limiting how generous mileage deals can be. There's no army of Chinese cardholders racking up miles on everyday purchases to later redeem for flights. Thus, Chinese carriers' loyalty programs remain mostly a customer retention tool, not a profit center. We don't see billions of dollars of selling miles revenue on their books. By not having that boost, Chinese airlines are more dependent on ticket sales alone to make money. A tough proposition given everything we discussed. To illustrate, American Airlines' A-Advantage program was valued at $20+ billion and brings in perhaps $4 billion a year from partner revenue. Air China's Phoenix Miles has nowhere near that monetization. The contribution of loyalty to total revenue at Air China is murky, but it's likely small. Some analyses suggest frequent flyer members account for 40% of revenue, but that's just member travel, not ancillary sales. The key is that US carriers can subsidize low fares with fat credit card deals. Chinese carriers cannot to the same extent. This leaves them with a relative revenue disadvantage. 4. Ancillary revenues, or lack thereof. Ancillary revenue, things like baggage fees, extra legroom charges, onboard food sales, etc., has revolutionized airline economics globally. Ultra-low-cost carriers, ULCCs, make huge portions of revenue this way. For example, Spirit Airlines earns nearly half its revenue from ancillaries. Chinese airlines, especially the state-owned ones, were slower to adopt this à la carte model. Full-service Chinese airlines typically include checked bags, meals, and seat selection in the ticket, especially on domestic flights. Only recently did they start charging for some extras, like preferred seating or additional baggage beyond a free allowance. As a result, the ancillary take is low. By contrast, China's pioneering low-cost carrier, Spring Airlines, has embraced ancillaries. Spring charges for checked luggage, sells meals and merchandise on board, and even famously once floated the idea of standing seats to pack more passengers, a proposal not realized, but indicative of their mindset. Spring Airlines gets an estimated 13% of its revenue from ancillary services, a significant share that helps its profitability. In 2024, Spring's ancillary revenue, from baggage fees, seat fees, etc., was about 1.03 billion yuan, boosting its bottom line. Meanwhile, the big state carriers likely have single-digit ancillary revenue percentages. For example, historical data from 2019 showed Spring's ancillaries were only approximately 5% then. It has grown since. Whereas Air China, China Eastern, and China Southern were not even broken out in rankings, implying low contribution. They only recently started unbundling some fares, e.g., a no-frills economy fare with no free checked bag was introduced on some routes. That's changing gradually, but cultural expectations of full service and regulatory oversight have kept ancillary potentials down. The result: Chinese network carriers leave money on the table that airlines elsewhere eagerly grab. They haven't been charging $30 for the second checked bag or monetizing priority boarding to the same extent. Spring Airlines' success in being China's most profitable airline in 2023 to 2025 is partly due to its fee-based model and lower cost base. The big guys are trying to emulate bits of that now, but they're playing catch-up on a revenue stream that could meaningfully lift RASK if done right. All these factors cap how much Chinese airlines earn per passenger. Cheap base fares, due to competition and policy, substitution to rail, and underdeveloped ancillary loyalty revenue keep RASK low. It's a recipe for thin margins even in good times. Indeed, even before COVID, Chinese airlines had margins far below those of US majors or Gulf carriers. They often relied on volume and occasionally government subsidies, like rebates on jet fuel taxes or support for unprofitable routes, to break even. When COVID hit, it blew a hole in revenues that government aid patched with capital injections. Post-COVID, the structural revenue challenges remain. In short, it's hard to make money when your average ticket prices are low and you're not extracting much beyond the ticket. Next, let's see how this plays out in practice by comparing different types of airlines in China. To ground all these concepts, let's look at two carriers as case studies, each representing a category, a flagship state-owned airline and a private low-cost carrier. We'll see how their fortunes diverge and why. Case 1. Air China, the flag carrier. Air China is the nation's flag carrier and a member of Star Alliance, with a hub in Beijing. One might expect the flag carrier to be financially strong, but Air China encapsulates the industry's struggles. In the first half of 2025, Air China still posted a net loss of 1.8 billion yuan, approximately $250 million, even though that was an improvement from the prior year. It has significant international routes, which were slow to recover, especially flights to North America and Europe remained at reduced levels until late 2023. That meant Air China's revenue mix was weak on the high-yield side, business travelers, long-haul. It also faced the intense domestic competition and fare pressure we described. On costs, Air China is burdened with a relatively older workforce, higher legacy costs, and significant dollar debt due to large aircraft purchases. It's the primary customer for China's new COMAC C919 as well. In short, Air China struggles with oversupply on domestic routes, underutilized international capacity, and all the structural cost issues. Not to mention, as a flag carrier, it might run certain politically important routes at a loss, for example, maintaining flights to smaller countries for diplomacy. Its loyalty program Phoenix Miles hasn't been a cash cow, and ancillary revenue is minimal on its full-service model. Thus, despite prestige and scale, Air China's margins have been poor. In 2024, along with its peers, it was still loss-making. One interesting advantage Air China and peers did have was access to Russian airspace in 2022 to 2023 when European carriers were banned from it. Chinese airlines could fly shorter routes to Europe over Russia, saving fuel and time. This gave them a cost edge on Europe-Asia routes during that period. However, the overall slow return of Chinese outbound tourism and business travel meant they couldn't fully capitalize on it. It's an example of a unique factor that could help margins, but not enough to swing to profitability. Case 2. Spring Airlines, the low-cost leader. Spring Airlines is a privately owned low-cost carrier LCC based in Shanghai, and it has been a rare profitability star in China. Spring was the most profitable Chinese carrier in the first half of 2025, earning 1.2 billion yuan net profit, even as the big boys were in the red. How? Its model is radically different. Spring Airlines operates with a laser focus on cost. It uses a single model fleet of Airbus A320s, packs them with high-density seating, and keeps planes flying as much as possible. It pays lower salaries on average, smaller company, more flexible contracts, and has no legacy burdens. Spring also targets leisure and VFR, visiting friends, relatives, travelers with rock-bottom fares, but then charges for everything beyond the seat. This à la carte approach brings in ancillary income that others miss. Spring also benefits from network nimbleness. During the pandemic recovery, it ramped up flying to nearby international destinations like Japan, South Korea, and Southeast Asia as soon as restrictions eased, capturing pent-up demand for tourism. Those short-haul international routes can have good yields if timed right. And with no wide-body aircraft, Spring didn't suffer from the long-haul downturn. It could redeploy capacity domestically quickly. Its load factors are consistently high, often over 90%, meaning its flights are full and unit costs are spread over more paying passengers. Essentially, Spring's CASK is low and its RASK is augmented by fees. That's how it manages to earn money where larger airlines cannot. It's not all rosy. Spring's margins also tightened in 2023 due to fuel prices and competition. Its 1H 2025 profit was actually down 14% from a year earlier. And Spring is still much smaller than any of the big three, with maybe approximately 100 aircraft versus 700 plus at China Southern. So it can cherry-pick profitable niches. If it tried to scale massively, it would face the same market challenges. Nonetheless, Spring Airlines proves that a different business model can overcome some structural issues in China. The fact that every private airline, Spring, Junyao, China Express, etc., was profitable in early 2025, while the state-owned trio were not, is very telling. The private carriers are more disciplined on costs and capacity, whereas the state ones often expand for market share or political reasons, even if it erodes yields.